Austin, before we get into the economic outlook and the Midwest economy, please tell us a little bit about yourself and what is the Federal Reserve Bank of Chicago and what does it do? I know there's some people here that know a little bit about it. What do you do?
That was when I decided to apply for the job. I had exactly the same question. Raphael Bostic is an old pal of mine from the Obama administration and was the president of the Atlanta Fed. And I called him up, I'm like, what do you do all day? You know, why does Chicago have a Fed? Let's back up to that. In 1913, they set up the Federal Reserve System. And in 1913, as today, people were fundamentally uncomfortable with the idea that New York City and Washington, D.C. would have complete control of the financial system of the United States. So they didn't want to just have political appointees and the New York Fed running everything. So they created a system which, yes, it's clues. I'm going to describe it to you and you're going to be like, this is insane. There are 19 people who sit around the table of the FOMC meeting where they decide on the interest rates. 7 of those people are political appointees at the Board of Governors, including Jay Powell and people that are confirmed by the Senate, nominated by administration. They serve 14-year terms as governors. The chair and the vice chairs are 4-year terms as chair, which are not on the presidential cycle. So they tried to set up the political part to be as not politics related, and then they set up 12 reserve banks around the country to represent regions. Ours is the 7th district. It's most of Illinois, Wisconsin, Indiana, Michigan, and Iowa. So it's kind of heart of the Midwest is the Chicago Fed District. And those aren't political appointees. They're not even government agencies. We're a not-for-profit. We have a board that's made up of banking and business and civic leaders from the region, and those are who choose to be the heads of the Feds. Why does Chicago have a Fed? That's why. What do they do all day? They kind of do 5 things. The opposable thumb, like that's what separates us from the animals. The opposable thumb is monetary policy. Okay, every 6 weeks, you go to Washington, D.C. It's amazing. If you're an econ nerd, it's the coolest thing in the whole world. You get a huge table, the shades come down so nobody can spy on it, and they go around the tables. Jay Powell's like, here's what I see in the economy, and here's what I think is going to happen. And they go, each person speaks their piece. But there are almost 2,000 people who work at the Chicago Fed. And it's a working entity that does more than monetary policy. Point 1, it's a bank to banks. And the banks have accounts. We have, I'm not supposed to say the exact number, so I'm going to tell you, a lot of billions in cash in our vaults, and we run hundreds of millions of dollars a day in and out that the bank will say, we need more money for the ATM machine, deduct it from our account. They'll send a Brinks truck, they will send it out of there. And it's an awesome physical operation. We do a whole bunch of other financial services for the banks. 2, we're the bank supervisors. And we don't set the regulatory policy, that's set in Washington. But we are the ones who have the bank examiners who are out there on location, making sure that they're complying with all the laws, have enough capital, et cetera. We run as a system a bunch of the payment plumbing for the U.S. financial system. So most of the wire transfers, ACH, direct deposit, a whole bunch of those things are running on the Fed's lines. And then each of these reserve banks is supposed to be an upstanding member of the community. And we do regional events. We tour around. As I say, it's kind of like small town mayor for the economy. We'll go visit. We'll go to the Iowa Farm Bureau meeting. We'll visit factories. But now my My latest is, it turns out that the largest cookie factory in the world is in Chicago. We got to go do a site visit. And I guess they make Oreos there, and they make some of those. So that's kind of the five. That's kind of the five things that the Fed does.
Sure.
Yeah.
And so you're just finishing your second year there?
Yes. Dog years.
What
If
most
ever
surprised
was a
you?
dog year.
What most surprised you about the job when you come in that you didn't expect, or when
I kind of expected the monetary policy part of the job. As an economist, I was very familiar with the Fed. This whole cash thing blew me away, and I love it. I didn't know I was like, I need to see this money. I thought it was going to be piles of money, like the cartoons or something, but it's very organized. There it's in straps and bags, rolling, and they roll these containers around. But seeing that and the machines, the money comes in, they run it through the machine that does high-speed counting, pulls out if there's dirt on it or anything, they shred the money. And if you come down, we have a free money museum, which is actually pretty interesting if you've never seen it in the building. And if you want, they'll give you free shredded money, $5,000. People like to joke, oh, well, can you get free money? I'm like, yeah, and it's just shredded.
I worked for State Treasurer Pat Quinn in the 90s as deputy treasurer, and we used to hand out the shredded money.
Yeah,
People
exactly.
loved it.
Yeah,
People loved it.
totally. So seeing that physical operation and just seeing, somewhere between 30 and $50 billion with an amount I'm not going to say, is pretty notable. That was kind of a surprise. And the other thing, the vibe of the Fed among the employees is absolutely mission. They're believers. As I say, the universe is as big as this, and the Fed's part of the universe is only here. But in this part of the universe, the Fed really matters, and everybody who works at Chicago Fed knows that. If you just ask anyone there, what do you do? They're kind of like, I'll put people on the moon. They feel like it's NASA or something. So I say, we're 90% NASA and 10% the DMV. It's kind of a...
Great. Well, let's just jump into it. So tell us, what are the key economic trends for 2025, particularly with the Midwest, and how does the Midwest relate to the nation?
Yeah, look, on both sides, that's a pretty deep deal going. I mean, the first thing to note, if you're not super into regional economics, is that the U.S. national economy is pretty well integrated. So for the most part, as goes the nation, so goes every region. And that's very true in the Midwest, and that's very true for Chicago. Now, that said, we got a few things that Chicagoland area is more intensive in than the national economy, and some that were less. Mining and minerals is very low for our region. Manufacturing, the 7th district is by far the biggest manufacturing of all the districts. Chicago itself, transportation, logistics, professional services, those are kind of our three,
Sure.
And financial services, if you want to lump it in. Those are kind of our 3 to 4 most distinctive, most intensive. And in some of those, it's been a rocky patch for a couple of years. We had this strange dynamic, extremely strange dynamic in manufacturing. Normally, manufacturing's among the most cyclical parts of the economy. So a lot of times people will look at this Fed district as a leading indicator of where are we in the business cycle, because consumer durables, business investment, stuff like that tends to go up quite rapidly in booms, tends to go down quite rapidly in recessions. COVID hits, and we have the first recession ever that's not driven by cyclical industries. Demand for consumer durables goes up. Everybody buying Pelotons and TVs and trying to get a car because they cannot spend money on services, which are normally have nothing to do with the business cycle. They just kind of chug along. So now, as we came out of COVID and people have gone back to spending most of their money on services, it's added kind of a second weight on the shoulders of manufacturing, separate from just the business cycle that we've been dealing with a little bit. That said, because our population growth has been slower than the rest of the country, overall economic growth has been a bit slower than the rest of the country. But as I say, part of that is our industry mix. It doesn't help us when it's 3 below zero with the wind chill, but by next week, that'll be back going in our favor. The other aspect that's hit us, as you know, is big cities and the sorting out of are people going to return to the office and the health of the downtown areas. Chicago's not alone in trying to sort that out. A lot of the big cities are dealing with that. But our professional services, and especially healthcare, really chugging along, booming as a big driver. And the transportation logistics coming out of O'Hare, there's also a lot of demand for that.
Right.
Yeah.
Right. And so inflation, obviously, that's had a great impact on our economy. And I think last week we had a 0.5% increase in January, and you were quoted in a New York Times interview as calling it sobering.
Yeah, right.
So what should people in business think about inflation, where we're going?
Okay,
and I'm not even going to get into tariffs yet because that's coming later.
Okay, so then we'll think about tariffs. Here's the thing of conventional wisdom for central banks always held that if inflation goes up, you're going to really have a heck of a time getting it down. You basically have to have a bad recession to get inflation down. And that's partly why people were as amped up whenever they see inflation. They're like, oh no, if inflation goes up, it's awful to get it back down, so you got to never let it go up. So we go through a period, everybody knows, we get inflation way higher than we wanted it, way higher than the target. The Fed has an explicit inflation target of 2%, but not to get in the weeds, it's not of CPI. The number that came out in January was for the Consumer Price Index. There is a different measure of inflation called the Personal Consumption Expenditure Inflation, which is better than the CPI. The CPI is a basket of specific goods that they just check the prices on. PCE inflation is every single thing that consumers spend money on. That's why we made the 2% target on that. I only take that diversion to say the CPI number was not great. The PCE number, turns out, is probably going to, still not great, but it's not as sobering as the CPI number. Because conventional wisdom was you need a recession to get it down, the experience of 2023 and going into 2024, where inflation fell almost as much as it has ever fallen in a single year, and the unemployment rate never got above 4% while it was doing that, is totally unprecedented. That has never happened. I started calling that the golden path, and people said it wasn't possible. You'll remember there was the Bloomberg story in December of 2022, just as I was coming in at the Fed. 100% of economists, they said it was a 100% chance of recession in 2023. And it was rooted in because inflation has to come down, so it's going to be a problem.
Was it really 99.99? Because you were not.
Yeah, no, I was like, nobody asked me. You know what I mean? It was like the polling. But I think with inflation, it's extremely important to take the long view and try to find the through line, because it's extremely variable. You get months like the one we just saw where it's up. Then you get months where it's down, and it's this, and it's bouncing around. So you got to like take one step back. Inflation's way down from where it was. It got way, way too high. So it had a long way to come. But my view is before we got to the uncertainties from policy and from geopolitics and from some others, the overall thing looked pretty good to me. The unemployment rate is 4%. Inflation been coming down on a path to 2%. And that's the law. The Federal Reserve Act says by law, when we set monetary policy, we're supposed to stabilize prices and maximize employment. That's what we call the dual mandate. And that's all we're supposed to do. Now, that doesn't make it easy, but it's very simple to understand that the Congress and the President, the law has narrowed our field of vision to be just this. Here's what we're supposed to look at. And on dual mandate grounds, these have been some very good years. So I want us to continue that. I think if not left to its own devices, but kind of left to its own devices, the fundamentals of the economy are, it's not a recession. The consumer has been predicted to fall off a cliff every quarter for the last 2.5 years. They've been saying, oh, this might have been a good quarter, but now everybody's going to have to pay the piper and they're going to fall off a cliff. And it's still happening again today. We had a very strong Christmas season. Consumer spending was high. And now you hear the naysayers, oh, it's only a matter of time. Now the consumer's
By the way, there's some
fall.
Bankers in this room, and they say the same thing. The cloud over the horizon. But we had a record year.
Paul Volcker was a dear friend and mentor and really personal hero of mine. But he was fundamentally a very pessimistic person. And he once told me, he said, there is no silver lining that I cannot find a cloud dark enough to block it out. that was his thing. So look, in a way, that's what it should be. If they say, what keeps you up at night, central banker's job is not to sleep at night. There shouldn't be anything that happens that we haven't at least thought about that scenario. And like, we'll nap in the daytime,
And so you're the Midwest.
Yeah.
When you go to these meetings, are you representing the Midwest and what's happening, or do you look at the whole country?
Yeah. Well, we look at the whole country. Part of the dynamic is, as I say, it's a very well integrated national economy. So mostly what's happening to the national unemployment rate, what's happening to national inflation is also what's happening in our region. But I absolutely report what I hear from talking to business people from our region. And there's a formalization of that. It's called the Beige Book. I don't even know if there's a physical. It used to be beige, and that's why it was called the Beige Book. Now I think it's a PDF. But in that, each of the regions reports from their contact calls. We have many, 30, 40 round tables a year all throughout the district. We're constantly talking to business people on our board and not on our board. And we're especially big in auto production. I like to say we're the 7th district is like the Saudi Arabia of auto production. And so when things happen like tariffs now that are going to have a disproportionate impact on manufacturing, I will absolutely be down saying, hey, wait a second, us in the Midwest, we got to be very concerned about that. Of our states, 4 of the top 7 affected states by tariffs are of our 5 states in the district. And Illinois itself, on this list came from the Tax Policy Center in DC. I think Illinois was number 6 or 7, but Michigan is one of the highest, Indiana one of the highest, Wisconsin one of the highest, because we got a lot of manufacturing, and
right.
those are costs of production.
So you said the Fed's job is to keep inflation at 2%, maximize employment, but there's lots of things going on in how you look at those things.
Yeah.
You mentioned tariffs, and we're a large manufacturer here in Illinois,
Yep.
so that's going to impact us. Some of the geopolitical things happening in the world, a change in administration where a lot of policies are changing. Even though you don't get into that, but that affects how you look at those two things. How are those things going to be affecting inflation, employment, and as you look at the future?
You said that nicely on all of the dimensions there. I described how they set up the Federal Reserve to be as independent of politics when setting monetary policy as it is possible to be. And we take that seriously, and part of that is it a covenant? Is it a something? We don't comment on this is a good fiscal policy, this is not a fiscal policy. As I always say, Chicago motto, there's no bad weather, there's only bad clothing. You tell us the conditions, and then we pick the right jacket. And fiscal policy, geopolitics, all of those things, if it affects prices or it affects employment, then the law says we have to think about it. But I don't tell you what to order at the restaurant. I just say, look, what are the prices and what is the menu? And if tariffs drive up prices, then we have to think about them. That's different from saying Congress and the president can do whatever they think is appropriate. If they want to pass tariffs, they can pass tariffs. But then we got to do our job and try to think that through. So that's what I've been trying to do. It's part of that job on policy is getting a little easier because now they're actual proposals. In previous periods, people will, well, what would you do if they change something to this? And I don't like to get in hypotheticals of that form. And I was going to say but it's not a but, it's an and. It's worth remembering what matters is everything combined, not just one at a time. So if you cut taxes substantially, cut government spending a lot, put in a tariff, change immigration policy, the whole policy thing, what matters is all of that combined. And conditions are changing, are ever changing.
Right.
There's nothing, some of those could come from policy, but some could come from the productivity growth rate is changing, or conflict in the Middle East is driving up the price of commodities, or all stuff happens all the time. And that's the job, is to just keep monitoring, keep running the scenarios and think about setting of monetary policy, this part of the universe, how do we stabilize prices and maximize employment?
Right, right. And so with that, part of yours maximizing employment, how do you see the labor market in Chicago and in the Midwest? Are we seeing signs of strength?
I think
the whole
signs of
immigrant
strength.
thing,
Yeah.
we are a nation of immigrants, but immigrants have helped fill the workforce, and that's helped fill jobs. So how does all that fit in and what you're seeing in the future for a labor market?
We have had an epically strong labor market. Some would say coming right out of COVID, too strong, so strong that wages and labor shortages characterize the job market as to be as strong as anyone could remember, and like maybe all the rules are off. We've moved to a period which looks more like stable full employment to me. And for a variety of reasons, the tent pole statistic that we usually pay attention to, and you'll see if you watch CNBC, Jobs Day, and they play the final countdown, music down to the second when the number comes out, that number of jobs created for the month was always everybody's first thing that they look at. For a variety of reasons, that's gotten noisier. So we got to look at a series of measures. If you look at the series, it says this is what full employment looks like. and it's pretty stable. I was getting a little nervous as of last summer that from an extremely low base, you had seen actually a fair amount of increase in all of the measures of deterioration and of cooling. The unemployment rate was up. The ratio of unemployment to vacancies showed cooling. The hiring rate, the voluntary quit rate, a series of things, all were cooling. And if you looked in the past, the direction of change was very indicative of where it was going. So if unemployment rose a full percentage point in a year, it virtually never stops. It turns into a recession. So in the summer, I was getting a little concerned, but this time it did stabilize and now has even come down a bit. So I think the job market remains pretty strong. The immigration part is still just a question mark. We don't know what's gonna, if you more than half the labor force expansion of recent years, and I'm going to make up the number, but it's approximately right. Let's call it the last 10 years. More than 50% of labor force growth has come from new workers, predominantly immigration. So if you shut that channel off, it would affect the labor market, but we just don't know. You know, we're going to have to play by ear on that.
Right, great. So this is our mid-market council. A lot of middle market companies, part of the Chicagoland economy, part of the chamber. They don't have economists working for them. They don't have they just have their heads down and they're moving forward. A lot of our manufacturers.
Yeah.
Any advice you have for them as we move forward with the economy and where we're going?
I mean, I'm going to be very interested to hear what's on your mind. It partly depends how mid is your market. On the credit side, as you know, we've got this dynamic where the closer you get to public markets, credit's been, I won't say easy, but kind of easy. And the more you've been reliant on bank loans, the credit conditions with the Fed having raised rates as much as it did have been fairly tight. And if you look at like what does SLOOS stand for? The Senior Lending Officer Opinion Survey. That's what it must be, the SLOOS. It hasn't been that easy of a period. So we've been in this weird bifurcated world. I would say, is it advice? Yeah, buckle your seatbelt. I mean, we've had supply chain bumps like we've never seen before coming through COVID. I gave a speech at our Auto Insight Symposium last week that was trying to apply the lessons. What are some of the things we learned about the supply chain in COVID? And what do they tell us now? Impact of tariffs, impact of other things that might hit the supply chain. And basically, in the short run, the supply chain is more specialized and therefore more fragile than we understood. That was one of the lessons of COVID. And that the spillovers things, that you could have some problem. People got sick in Asia, so they couldn't make as many chips. So then you can't make cars because their chips aren't there. And then the rental car companies can't get new cars, so there's a shortage, and the rental car inflation pops up. Then the delivery companies and anybody whose cars are an input, their prices go up. And that, like, spilling from one industry to the next took a lot longer than we would have thought it would take beforehand. So that does make me a little nervous thinking through the impact of anything that's going to look like a supply shock a la COVID. Are we going to be back dealing with extended, as they started saying, they initially said inflation was going to be transitory because they said the supply chain will fix itself. And in the end, it became transitory, okay? But the people who said it was all about the supply chain still to this day say, no, we were right. It just took 2 years, and we thought it was going to take 2 months. So my only advice to you is go figure out. I mean, who am I to be telling you advice? I mean, you know your business, but go figure out this idea that the economists bring to the supply chain is it's all about substitutability. If you can substitute to different suppliers or different production process, then you're not going to have to eat it. But if you did not resilientify or whatever it is, make more resilient the supply chain after COVID, you better just go think this through, because if you talk to the auto industry, for example, that's the mother of all supply chains. One car has up to 30,000 parts in a single model of car. And every single one of those parts has got its own supply chain. So the thought that there would be a 25% tariff on every single thing every time it comes across a border has them not in a panic, but they're very concerned of who will have to eat those costs.
Do tariffs drive up that transitory onshoring? No, it doesn't.
Maybe. I mean, it partly depends on the size. So if you look in 2018, we did have tariffs. There were a lot of exceptions to the tariffs, and they weren't as big, and they went immediately into prices in the affected industries, but they didn't have really a material impact on national inflation. And it looked like, if you go look at the data, it mostly worked its way through within the year. So it wasn't the transitory part. The COVID shock was way, way bigger, and it had this very extended feature. So in a way, if you're just thinking about tariffs, it depends how many countries are they going to apply to and how big are they going to be. And the more it looks like a COVID-sized shock, the more nervous you should be about that.
Right. Let's turn back to a little bit more about Chicago. What do you see Chicago's role in our economy as it contributes to the national economy? And what are some unique opportunities maybe businesses have here in Chicago, given the national economy?
I would say there's no question from an economic perspective, Chicagoland region is the capital of the Midwest economy. If you just look the transportation connections and the economic networks, it's really quite central. I would say those industries that I described where we're much more intensive than the nation, transportation and logistics, O'Hare, railroads, a lot in that space. That's an area of growth. We have a strong, would you call it an IP base? I mean, we have great universities in the region, a source of a lot of new technology. There's a guy at Harvard, Ed Glazer, who's a friend of mine, is one of the leading urban economists anywhere. And he wrote a paper that asked the question of cities that have succeeded decade after decade and compared to cities that have not succeeded decade after decade, what are the things correlated with having a robust economy? And he found 3 things dominated. One was, since the invention of air conditioning, what is the temperature in January? And the Sun Belt and hot places, since they've invented air conditioning, have been drawing population. 2, how diverse the industrial base is of the regional economy. So one company towns with all large firms tend to do worse than cities that have lots of industries and lots of sizes, small, medium, large, and a kind of a diverse ecosystem. And 3rd, what's the skill base of the workforce in the region? Now, by those measures, the weather, we could still use some work, but
Global warming
we
will get
have
better.
as much, it's warming up. We have as diversified an industrial base in Chicago region as any metro area in the United States. And we actually have a pretty skilled workforce. So I don't think it's a coincidence that if you look at the Midwest region where the weather is approximately the same, Detroit, St. Louis, Cleveland, you got a series of metro areas that have really suffered. And Chicago and Minneapolis are the two that have stayed, pretty stable. And they're the two most diversified economies, and they're the two highest skill base of the workforce. Now, a city can still screw it up. Like we shouldn't. I'm telling you, we have a lot of pieces that in the past have historically, those are good bones to have for your house, but we're going to have to work through a series of whether they're public safety, urban amenities, finances, et cetera. But I don't worry about those really quite fundamental parts. And the exemplified by the chamber, Chicago's always had an amazing civic, private-public civic partnership mentality in a way that is quite distinctive. There are not a lot of cities that where the civic engagement of the business community is like what it is in Chicago.
Right, yeah. I agree with you. We've got the DNC last year.
Yeah.
The committee that came to visit said, I've never seen a city where the civic leadership, how can I help? What can I do to make you successful?
Yeah, and decades of precedent of culture, that's kind of like woven into our DNA or something.
Right, yeah. Right. So what are some areas you see where innovation's happening, the future? Like, I know we got the quantum,
quantum
computing, quantum computing and all that. What's some things in the future that our members should be looking at and thinking about from an innovation standpoint?
I mean, who am I? I should just be asking you, what's the new? You're as a guy from the Fed, like, hey, how do you get on the cutting edge of whatever? That's not our thing. But as an economist, I would just note there's tentpole advertising, the things that get good press, quantum computing and AI and the headline kind of technologies. Seldom are those headline technologies the bread and butter of growth for a city. They're professional services, especially healthcare that I mentioned. These have been major drivers of employment. If you look in the city, 4 of the 5 biggest employers are health centers, hospitals, medicine world related, and the other is Amazon. And so I do think that growth, Chicago's growth in both financial, leisure and entertainment, healthcare, a series of services, that has been the wave of the future for a long time now. And we're not ill-posed. We're not in a bad situation to be in that future, but it's worth just reminding ourselves it's not all about quantum computing. How many quantum computational engineers are going to be working there? It'll be something. It'll be some number. Even in their wildest dreams, is it going to be as much as a big hospital? I don't know.
Yeah. But of course, healthcare and all that, a little bit that's driven by government spending. And the long-term economy's got to be you make things, you produce wealth, produce growth that way.
Fair point.
And you look at, our governor gave his budget address yesterday, and there was a deficit. The mayor had a deficit, but they kind of overcame it. A lot of it's like these one-time things.
You're trying to get me in trouble. I'm not getting in it. I already told you. Fiscal policy, that's, They
But what
got to figure that
drives
out.
growth?
They got to figure that
What
out.
drives
What drives growth? Your intuition. 90+% of what drives growth has nothing to do with Washington, has nothing to do with Springfield, is not the government, is the private sector that drives the growth. At the end of the day, there's a famous in my world economist, Bob Solow, who studied growth. And he said, in the end, when people ask, what are the true drivers of growth? He said, we always go down in a blaze of amateur sociology. And there is something to that it's kind of like, well, it's our pluck, it's our entrepreneurism, it's our can-do attitude. At the end of the day, innovation and new ideas and productivity growth, just making more per hour of worker, per machine, that is what made us the richest major economy in the world. And if you look at our real income, compared, Warren Buffett used to, I met Warren Buffett a little, he was an Obama supporter, and we did several events together back in 2008. And he always has like some funny quiz if you meet him. And so his thing was, what do I think the Dow was in 1900? And I was like, there was a Dow in 1900? Yes, there was. And the Dow was at 50. Okay, in 1900, the Dow was at 50. And he said, think of everything that went wrong from 1900 to today. And imagine you were Back to the Future style. You went back there and you were like, here's all of what's going to go wrong for 125 years. What do you think the Dow will be in 2025? And they'd be like 80, like 90. There's world wars, like everything going to go wrong. How did it get to be, pushing 40,000? The answer is because innovative capacity of human beings and of the American people have proved unbounded. And at the end of the day, that's still going to be, we're going to look back in 20 years and 50 years and whatever, and we're going to be like, wow, what a crazy time that was. But we're still going to be like, can you believe people used to drive themselves to work? 40 minutes each way, like an idiot. And if you don't think that's true, go put on some old TV show and look at the phones. Okay, they're like huge brick. You'd be like, what? Was that a phone? And
Star Trek, man.
Yeah, Star Trek flip phone. And
so a couple more questions, and then we'll open up to the audience. What public-private collaboration? What can government, Federal Reserve, business leaders, what can we do together to foster resilience, growth, both in the Midwest and nationwide?
We need it. We need civic engagement and partnership of public and private. I think for the city, increasingly the lifestyle attraction of cities is quite fundamental. What in our language they call the urban amenities, and the public-private sector working together, the only way we're going to deal with those. Thinking through if you come down and visit the Money Museum at the Fed, we're on LaSalle, right by the Board of Trade, and that's been a hard hit part of downtown.
Sure.
And like how we're going to process the return to office issues, downtown office buildings, that's going to be a key driver of urban areas, and it doesn't feel like something that can be sorted out by just the politicians or by just the private sector. They're going to have to think that one through together.
Right. And what should businesses and policymakers be prioritizing for long-term economic growth and competitiveness? You mentioned productivity. Education and workforce development, because that makes our workers more productive.
Look, I totally agree with you, and I identified that does matter in the data. It's not just pie in the sky. if people ask me what's one data thing that you watch that nobody talks about, I always say productivity growth. And I understand why they don't do the final countdown the way they do for jobs numbers on productivity growth, because it's an extremely variable number. But at the end of the day, it's worth noting that in the last 2 years, productivity growth has been extremely high, well above what the previous prior to COVID trend was. And now we're all just trying to figure out, and it's up higher than if you had extended the trend line through COVID. There was a time when it went down and it was coming back, roaring back, but everyone said, yeah, it's just going back to the trend line and then it's going to settle out. But it hasn't. It's over the previous trend. If that continues, the implications for not just monetary policy, for the economy, how fast wages can grow without there being inflation, all of those things are going to be fundamentally altered. So I would say keep an eye on that. And whatever we do to increase our productivity, one of which is educating our people, one of which is pressing on the technological frontier, another is business adopting these new technologies and ideas. That's the thing that makes us rich. And that's, to me, that's where the growth comes from.
Right, right, great. So do we have some questions from the audience?
Yes, we do. We have many great questions. Some are still coming in. We did get a question about who's going to win the next Super Bowl, but I think for the best use of your time, I'll ask.
What do you mean best? Do you remember the old Superfans skits on Saturday Night Live? And one of them, they're asking the person, they're like, if the New York Giants played against Mike Ditka in the Super Bowl, who would win? And I'm like, the Superfans are like, Mike Ditka, 54-0, you know. So it's going to be Bears all the way.
All right, you heard it here first. It's going to be Bears. What do you see as Chicago's biggest challenges and opportunities within the next 12 to 24 months?
Look, I think our challenges, the biggest challenge facing all the major cities, I think, is this return to office, and what is there a rebalancing between downtowns and suburbs. It's worth noting this is not the first time in history that cities have had to navigate big tectonic changes like that. But I think that's a big challenge for Chicago, but really for all cities. And then we've got financial challenges that we're going to have to come to terms with. The biggest opportunities, like I say, we have a very diverse industry base. We have a quite solid skill level of the workforce. We don't want to sleep on that. If you neglect it, it's going to be to our detriment. But that's powerful. And outside of the winter quarter, we actually have a lot of urban amenities to attract people. Amazing festivals, amazing restaurants. The lake is wonderful, protected. People don't realize we've one year set out in our Christmas card a picture from the beach. And people are like, where were you? Is that, Cancun or whatever? I was like, no, that's literally a half mile from our house. We walked over to 57th Street Beach. Like, what? So I think the spirit, the mentality of Chicago, and let's go get after it, and let's all, lock arms, public and private, to do so, that's worth a lot too. So that's what I'd say.
Thank you. I'm going to read this question as is. Given the vast deportations, is that material to the jobs report, and consequently, will it have an impact on monetary policy?
Okay, so if they have big deportations, or if you change the population growth rate, it does have direct implications on the number of jobs created. And partly when we were talking about the jobs numbers before, I said for various reasons, the numbers have been hard to interpret. Part of it was about the increase in immigration in the last year and a half. We thought the break-even level of job growth was around 100,000 a month. And then we started getting month after month well above 100,000, but nothing else in the economy looked like it was overheating. So then everybody starts looking around, it's not, if you have 200,000 jobs a month and the break even is 100,000, that's supposed to be an indicator of overheating, but inflation is coming down, not up. They've now gone back and found, because there was way more immigration than we understood at the time, that's probably why the raw number was bigger. If you had the opposite occur and population growth was just well below what you forecasted to be, the jobs number for the month would probably be a fair bit smaller. Okay, so we went from thinking the break even was 100 to literally 180. 80,000 a month was coming from the new immigration. So if it was just the opposite, we would start seeing jobs numbers of 20,000 a month. But in the same way, you shouldn't get all overjoyed at a big number when all you were picking up was population growth. You shouldn't get super fretted about the number being smaller if it's just about immigration. You want to start looking at some things that are ratios, like ratio of unemployed workers to vacancies, the quit rate, the hiring rate, the unemployment rate. Those don't go as wacky when you can't figure out what population is.
Thank you. And we have time just for one more question. So thank you to those who voted on questions. I've been trying to ask the most popular. For the everyday American, cost of living remains strenuous. Is there a way to rein in corporations that pass on the cost of inflation to the end consumer?
There's two parts of that. One is I'm talking about the inflation rate, and my mom is talking about how expensive it is, which is the price level. Okay, and so my mom is like, when you say you want to get the inflation rate to 2%, why don't you get the prices back to what they were in 2019? Okay, and then I try to say, well, we don't have a price level target, we have an inflation target. She didn't want to hear about that. The reason why we don't have a price level target, it's not really that different from my grandpa would never take us to the movies because in his mind, going to the movies is supposed to cost a nickel. He's like, I'm not going to go to the movies, that costs $20 to go to the movies, you know. And the question from the economic perspective is your real income. It's like the price level always goes up. What you want is for incomes to go up more than the prices are going up. That's left us at the central bank in a little bit of a conundrum or something that we can see people are pissed off at the price level. But our thing, the dual mandate says we're supposed to aim at the inflation rate and maximize employment because we just want incomes to grow faster than inflation. And there was a time when it wasn't happening, but now it is. Wages are growing faster than inflation. And the only way we would know to actually get the price level down is massive deflation, which would come about only by huge unemployment that would lead wages to go back down to what they were in 2019, but wages are a lot higher than they were in 2019. So I apologize, I don't have a great answer to that, except to tell you, we're trying to get the inflation rate back to 2% so that you don't have to think about it. The price level was going up for the whole time. It's just we weren't thinking about it because it wasn't going up so fast that it was noticeable, and our effort is to try to get back to the people aren't thinking about it.
So I'm going to actually ask the last question. You know, we're from
host
Chicago.
Yeah, right.
We're humble. We've
Yeah.
got this attitude like we're always striving to be better. We're our own worst critics. Just give us the final optimistic view about Chicago and what we have and why we're going to grow and what we have.
Look, I think it is our attitude, and we've been doing this for 100 and however many years. We've been through things like this before. When I came into the bank, I was like, look, what I want for the Chicago Fed is we have every bit the excellence that they have at the New York Fed. The New York Fed is the biggest of the regional Feds. I said, we have every bit the excellence, but with none of the attitude. And then they laughed, and I said, well, 10% of the attitude, we're entitled to it. But it's like that Chicago 10% of the attitude, and it's like we got 2/3 of what's in Manhattan with 1/3 the hassle and at half price. And that's a pretty livable combination as long as you can deal with January. You know what I mean? And at the end of the day, that's why I think it's going to be, I think the bones are good on this one.
Right. Yeah. Let's hear it again for Austan Goolsbee. Thank you.